welcome to the Forbes India show. I'm Shireen Bhan and we're in conversation with Anant Gupta of HCL Tech. Anant, appreciate you joining us here on CNBC TV 18. Let me start by asking you, because the mood in the country is very much achhe din aa gaye, aayenge nahi but aa gaye already. But as far as the tech business is concerned, unfortunately you've got to deal with global factors much more. What is the sense that you get today about the risks and the uncertainty, and whether it's gotten better since we spoke to you for the last quarter?
So Shireen, first of all, thank you very much for having me on the show. I think the key thing really is, while bulk of our business is global, the India footprint is extremely important. I mean, most of our delivery is in India. It's still 80% plus. So anything which gives stability and confidence within the country is always welcome, right? So it increases the investment mood of our global customers to invest in India, which indirectly helps us help them service globally as well as within the country. If I look at it from a global perspective, I think the market is hot, like I would say. There are two parts of the market. One is really the entire rebuild renewal market, which is large. Whatever numbers we use, whether it is TPI or ISG or others, I think those numbers are large. And our selective play in those markets is very clear. We don't want to win the entire market share. Selective participation where we are relevant for our customers, where we will be significant for our customers, we continue to play in that.
So how aggressively are you going to be vying for someone else's breakfast, lunch or dinner?
I think we are extremely hungry, right? And we will be vying for that. But like I said, it will be selective.
So do you see much more of the transformational type deal? I'm talking the 50 million plus kind of deals. Is that pipeline looking as strong as one would imagine?
I would say yes. If we just look at our pipeline as we speak versus the same period last year, I would say it's larger. So the pipeline is large. Significant amount of transactions which have transformational component in there, which does lead to a much larger deal value, right? The fact really is, if you look at the global marketplace, the number of suppliers is actually reducing.
Yeah.
And therefore, making sure that one is not spreading ourselves too thin is very important. And we focus on areas where we believe we use our expertise that we have successfully delivered for the last 3 years. We continue to demonstrate that going forward as well.
So infrastructure management services will continue to be the big play as far as you're concerned?
It will be a large play, given that, and there's, I think that's an extremely positive, position from our perspective, because that's a hugely untapped market. So while the software business has grown so much, and the Indian players, including us, have obviously penetrated a significant portion of that, I think infrastructure services or infrastructure management is still largely untapped.
But do you see some amount of softness creeping in there? Because while you continue to grow and you've registered a growth rate of about 5%, it's still lower in comparison to what you were clocking.
I wouldn't take a quarter number to take a decision on or draw a trend from that, Q on Q is 5%. I would say even if you look at it in a Y on Y perspective, it is not of 30%.
Okay.
So that's very large, right? And that too on back of a 40% growth rate on the previous year. So I would say these deals are large. Given that the nature of these deals are transformational, we're not looking at what do they accrue from a Q on Q perspective, right? It's a sustained position of executing these large term contracts, and once they move into steady state, they'll flow into our growth. So I wouldn't be worried about the specific sequential quarter.
Okay, so you're not worried about infrastructure management services in the performance quarter on quarter. Are you worried about the way that the rupee is moving today? Because, that clearly is a problem and a challenge, especially the volatility part of it as far as technology companies are concerned.
So Shri, let me just complete on the IMS and maybe just paint a new picture which we are seeing in the market. So there is standalone deals of pure infrastructure which are happening, and of course we are winning a good share of that given our leadership position there. But increasingly deals are also becoming integrated.
Right.
And customers are looking at, my run side of my portfolio, how do I optimize, how do I industrialize that portion? So naturally, when they're looking at Gen 2 outsourcing, they're saying not just the infrastructure, but let's look at infrastructure and applications together, or let's look at application and BPO together. So I think a lot of, it's increasing trend we'll start seeing going forward, that deals will start getting bundled.
Okay.
Especially in the mid-market, $5 billion to $15 billion companies wanting to take a more holistic, integrated view to some of their spend on IT.
Okay.
Now, coming back to the rupee, yes, I think, we've never created a business model based on the rupee to dollar conversion, or rupee to euro, or rupee to GBP. Yes, it's an important consideration in the sense that
it impacts your margins directly.
It impacts the margin and helps us look at taking more investment decisions for a longer term, right? So if you have, there is a certain business margin profile one designs when you run a business, right? And therefore, anything more that comes in during, due to currency, we would like to use that or accelerate some of our investment decisions, and therefore it helps in doing that, taking more bolder decisions around that space. So I would say to that extent it impacts, not impacts, but I would say it facilitates that specific area. Given our nature of business, the end-to-end model, increasing end-to-end model, I think we are lesser impacted by currency fluctuation as compared to others and other peers in the industry.
But what is the hedging strategy going to be at this point in time? If I remember correctly, you had a forex loss of about 142 crore rupees last quarter versus 158 crores. What is the hedging strategy going to be, and where do you really see the rupee? Because some would say that it's going to stabilize at between this 58-59 band. What are you working with today?
So first, I think there is no change to our hedging policy. I think we've had a fairly well-layered hedging policy that will continue. With respect to where I would see the currency, it's anyone's guess where it will be, but I think it will be in this range which we are. 58 plus minus 2 rupees is what I believe the market will play in. But again, like I said, it's very difficult for anybody to take a guess at that.
So every rupee appreciation impacts the margins by how much?
I wouldn't have the exact number, but I think about 110 BPS.
So do you expect that, given where the currency is and whatever volatility we do see, margins you will be able to maintain this 24 plus? I know the outlook that you've given is 20 plus, but you have to bring it down to the last decimal point when you talk to analysts. So do you believe this 24 plus kind of number is sustainable as far as you're concerned?
So the way we have designed our business model is the ideal operating range should be between 20 and 21. Given the mix of businesses that we have, right? Infrastructure end-to-end, RTB end-to-end, Gen 2 outsourcing, the engineering services that we have, I believe for us the ideal profit, the operating margin range will be between 20 and 21%. Yes, we will have quarters of much better, margin profile, but which I would rather use it for forward-looking investments than really.
That's a worry. Why do you think there's a concern on the street that you're not reinvesting as much as you ought to as far as SG&A is concerned? And that is something that a lot of analysts are talking about.
There is, and I think we've been trying to provide visibility to the analysts on that. So if you look at SG&A, it's not the S where we have an issue. So we continue to invest in the S part of the SG&A. It's really what we're doing is we're optimizing our G&A. So I think it's really tightening or efficiency in G&A that we're doing and not really squeezing anything on the S. In fact, the sales side, we continue to invest more than what it is.